Breaking news. With Outsurance, you always get something out. News Leader, proudly brought to you by Outsurance.
FirstRand is signaling steady progress towards its year-end targets after delivering a strong first-half performance. Now, the group reported an 11% rise in headline earnings per share, supported by solid momentum at its flagship brand F&B, as improving household affordability underpinned growth. While F&B and R&B were standout contributors, the group flagged higher impairments in the UK, the rest of Africa and at Westbank. Company CEO Mary Vilakazi joins us now to unpack the numbers in more detail. Mary, thank you so much for your time today. And I guess let's start off with the broader overview of the group's performance. Sentiment around South Africa is shifting, inflation is easing, and the SARB has cut rates by about 150 basis points since September 2024. Is that filtering through to the numbers?
Certainly. Thank you for having me. I think we have, let me just start with the rate cutting aspect. I think when we started with the rate cutting cycle, we signaled that it will take some time before households are in a much stronger position. And I guess that's really what's played out last year. I think we can see consumers benefiting from lower inflation and lower interest rates. And that started driving demand, particularly for mortgages in the latter half of the last quarter of the calendar year, let me say. So we started seeing a bit of an uptick for demand in residential mortgages, and as well as some demand for on the loan side, but with better customer affordability. So I think that is a positive that consumers will feel, but it will take time, because actually, if you just always reference back to what the repo rate was pre-COVID, I think we are still higher than that. So we mustn't forget that we've just come from a very acute position, but I think we're not yet in a place whereby we can say consumers are in a very strong position, but it will come. And then I suppose, are we seeing this in our business play through? I think definitely on the corporate activity side, private sector credit extension is looking positive, and we had always signaled that we're going into a cycle where it's going to be corporate and commercial led. So good to see that from an SA point of view, because you would remember that previously our credit cycle growth was actually led by households. And so we're seeing quite the opposite of that. So growth in the corporate sector, private sector extension signals the emergence of a new credit cycle, and then hopefully an investing cycle, because we've all been signaling that the structural economic reforms are going to put the country in a better place.
Yeah.
But what we now need to really now see is actually the investments coming into some of these projects that have been identified. So I think the momentum is overall positive, and our business is leaning strongly into it through activities in R&B and F&B commercial.
And just zooming in on that loan book with what you've just highlighted there, how are you approaching this kind of environment when it comes to lending? Are you being more prudent? And how are you managing to balance supporting client demand versus keeping the balance sheet healthy?
Yeah, so I guess that is really also an area where the group's strengths lie. So if for example, in Westbank, we've been seeing strong demand for vehicles. I think the industry car sales are up 16%. Our loan book grew about 14%, and this is on the back of a number of periods where there's been solid growth. So on the back of increased demand and better customer affordability, we increased our risk appetite. So whilst in the past we would have focused on low to medium risk customers, now there's a higher proportion of medium risk customers. So I guess we are constantly looking out for where there's demand and where is it that it's a risk appetite constraint. And similar to SMEs, I think we have identified that the country's SMEs require support, and we've got the resources to deploy to these small businesses, and I guess we continue to do that. We've expanded our risk capacity over the last while, and I guess we continue to grow. And I guess where maybe the discipline comes in, I think it's on asset classes like mortgages, I think at times it gets very competitive. The pricing for mortgages gets very competitive. And remember, this is now an asset that will be on our books for many years. So it is important that we write it at the right appropriate margin, to be able to cover us for periods like we've seen where interest rates can go as high as we've have to live through. So we have to be very disciplined on those kind of books, and then also on the RMB side, on the wholesale side, some of the assets that we actually originate are long tenured. And from the financial system point of view, it's actually better if the likes of pension funds and those kind of balance sheets sit with those assets. So, I always think that our role is to facilitate the structuring of the transactions, bring our IP together, and then get to a place whereby, when the deal is done, we then pass on those advances to other balance sheets. And we have actually executed on that strategy with good success in this period. And that resulted in an improvement in the margin. So ultimately, we don't necessarily grow a balance sheet. I think that's not always something that we chase. We would much rather have better risk-adjusted margins. We earn fees from these activities, and then also because we end up with a much higher margin business that's been good for NII growth. So I guess we can balance growing the franchise, because in RMB's case, the number of deals that they actually are able to do with that balance sheet velocity, it's more. So it means that they get called upon more. And then in F&B, we work hard to ensure that we are meeting the needs of our clients. So I guess our active financial resource management, we would look and say, okay, but how much of the credit demand are we meeting? And is it because of pricing? And is it because of our appetite? But we certainly have the resources, I think, to support our customers, our different customers across the group.
And just quickly, as we look at the outlook, the picture you have just painted is really supportive of getting growth going here at home. And we haven't seen such a positive picture of the South African economy in a while. But keeping the global backdrop in mind, this week things have become more uncertain with rising tensions in the Middle East, which have, of course, pushed up energy prices, raising fresh inflation concerns. Mary, are you considering that, especially when it comes to monetary policy outlook?
So it's certainly a concern. I guess from just geopolitical environment, I think when we look at the world, we think that the new world order, I think with it comes with a higher level of shocks that we should prepare for. So the Middle East war is an example of these shocks that we've braced ourselves, that we are going to see them a lot more often than in the past. Okay, so last year we had the trade, the Liberation Day activity. So I guess our baseline for us is one that takes into account the fact that we are living through a period whereby we're going to have frequent economic shocks, and so we monitor the situation quite closely. But if I bring back the current, particularly the oil price impact, it is a concern in South Africa because the inflation has been trending lower, and we need a lower oil price to ensure that we can keep inflation tight. So who knows? Let's hope that that this war is not prolonged, and that I think it does not also spread out to many countries. So that's something that none of us can tell. But what the SARB would do is pause any interest rate hikes, any interest rate cuts, in an environment where the inflation is not coming down. But over the next forecast period, we see it more as a delayed cut, as opposed to a cut that never happens, because I guess the oil price is not the only underpin to a lower inflation environment in SA. So it just means that we could have had rate cuts earlier, and then they will be delayed. But certainly not helpful from you always want to have some tailwinds coming from the globe. But unfortunately for South Africa, I think we are going to have to create our own tailwinds. And the structural economic reform momentum at least provides opportunities for South Africa's GDP growth to lift. So I think it's one of those moments where when we see what's happening across the world, we need to focus in SA and say, how do we make the country more productive? How do we make it work for the millions of South Africans who would want to see better prospects? And I think we have those opportunities that we need to focus on. And I think it's been encouraging that the government has had growth, and I think the commitment to structural reforms is top of mind, and our hope is that that continues.
All right, let's leave it there, Mary. Thank you so much for your time and sharing your insights with us today. That was Mary Vilakazi, CEO of FirstRand.
Breaking news. Switch to OUTsurance Business Insurance and get a 20% discount. News Leader, proudly brought to you by OUTsurance.